Ever wondered how we can tell when an economic storm is brewing? It's not as mystical as it might seem. There are key economic indicators that signal an impending recession, and understanding these is like having a weather forecast for the economy. Let's start with gross domestic product, or GDP. This is essentially a measure of all the goods and services produced in a country. When GDP trends downward for 2 consecutive quarters, it's a significant sign that a recession might be on the horizon. Another key indicator is employment data. High levels of unemployment can signal a struggling economy. If businesses aren't hiring, it's often because they're not growing or because they're actually shrinking. Next, we have consumer spending. The economy relies on you and me buying things. When we stop spending, it's usually because we're worried about our financial future. A drop in consumer spending can often precede a recession. Finally, there's market volatility. When stock markets start swinging wildly, it can be a sign that investors are uncertain about the future. This can sometimes indicate that a recession is looming. These indicators, when viewed together, provide a snapshot of the broader economic landscape. They're like the dark clouds on the horizon that tell us a storm might be coming. And just like with the weather, it's better to be prepared. So understanding these signs is vital, as they can give us a heads up before a recession hits. But what stirs up this storm in the first place, you might ask? Well, economic downturns, much like storms, are the result of several converging factors. One such factor is geopolitical tensions. These are conflicts between nations that can disrupt global trade, leading to economic instability. Think trade wars or territorial disputes. These kinds of conflicts can shake investor confidence and slow down economic growth. Next, let's talk about shifts in monetary policy. Central banks use monetary policy to control the supply of money in an economy, influencing interest rates and inflation. When a central bank, like the Federal Reserve, hikes interest rates to curb inflation, it can cool down economic activity. This can lead to higher borrowing costs for businesses and consumers, potentially triggering a slowdown or even a recession. Then there are supply chain disruptions. These could be caused by anything from a global pandemic to a natural disaster. When the flow of goods is interrupted, it can lead to increased costs and decreased productivity. This ripple effect can cause businesses to cut back on spending and hiring, which can lead to an economic downturn. Lastly, we have global economic imbalances. These involve disparities in economic performance and policies among different countries. For example, if a major economy like the United States experiences a slowdown, it can have a domino effect on other economies due to the interconnected nature of global trade and finance. All these elements, geopolitical tensions, shifts in monetary policy, supply chain disruptions, and global economic imbalances, can create a perfect storm that leads us into a recession. It's like a domino effect where one event triggers another, and then another, until the whole economy is teetering on the brink of a downturn. But fear not, for understanding these causes and triggers is the first step towards weathering the storm. So hold on to your hats as we dive deeper into the world of economics in the next scene. A recession doesn't just affect one area, it can send shockwaves across various sectors and markets. Let's take a moment to unpack the potential repercussions of a recession on different industries like housing, manufacturing, finance, and international trade. Starting with housing, a recession can significantly cool down this market. Elevated mortgage rates and high home prices can lead to lower levels of housing activity. The rise in interest rates, influenced by the Federal Reserve's aggressive rate hikes, can further dampen the housing market. However, it's important to remember that the housing market is resilient. Unlike the crash of 2008, current borrowers are less vulnerable to rate shocks, and the industry has healthier debt levels. Moving on to manufacturing, a sector that is often hit hard during a recession. Reduced consumer spending, disruptions in the supply chain, and increased production costs can all lead to a decline in manufacturing output. This, in turn, can lead to job losses and a decrease in overall GDP. Next, the finance sector. During a recession, banks and financial institutions can face a multitude of challenges. From a rise in bad loans due to borrowers' inability to repay, to a decrease in overall lending due to increased risk, the finance sector can take a significant hit. And lastly, international trade. Recessions can have a domino effect on global economies. If one country experiences a downturn, it can impact its trading partners too. Reduction in demand for goods and services can lead to an overall decline in global trade. Thus, a recession can have widespread impacts, shaking up industries far and wide. It's a ripple effect that can touch every corner of the global economy, reminding us that we are all interconnected. When the economic ship is sinking, who comes to the rescue? The answer lies in the actions of governments and central banks, who play a crucial role in mitigating the impacts of a recession. Let's delve into how they do this. Imagine a recession as a stormy sea and the economy as a ship navigating through it. When the waves are high and the winds are strong, the ship needs an experienced crew to steer it out of danger. This is where governments and central banks step in. Governments can put fiscal policies into play. These are like the ship's sails, adjusted to catch the wind and propel the ship forward. For instance, in times of economic downturn, governments might reduce taxes or increase public spending. This can boost demand, stimulate economic activity, and help the ship move forward even in the roughest waters. On the other hand, central banks use monetary interventions, acting as the rudder of the ship, guiding its direction. They can adjust interest rates or inject money into the economy, often referred to as quantitative easing. Lowering interest rates can encourage borrowing and investment, while quantitative easing increases the money supply, both aimed at stimulating economic growth. But it's not just about steering the ship, it's also about keeping the crew and passengers safe. That's where stimulus measures come in. These might include direct cash transfers or unemployment benefits to support individuals, or bailouts for industries hit hard by the recession. These measures aim to protect those most vulnerable and help them weather the storm. However, just like navigating a ship, these responses need to be well-timed and well-balanced. Oversteering or misjudging the wind can lead to further complications. That's why it's vital for governments and central banks to constantly monitor economic indicators and adjust their strategies accordingly. Indeed, the actions of governments and central banks can be the lifeboats in a recession. Their swift and effective responses can help the economy weather the storm, keep people afloat, and guide the ship safely to calmer waters. But it's not just about the big picture. What happens to you and me during a recession? A recession can have a variety of impacts on individuals and businesses. For individuals, a recession often means a rise in unemployment rates, decrease in consumer spending, and a tightening of wallets. For small businesses, it could mean a drop in sales, difficulty in securing loans, and potentially closures. Investors might see a decrease in the value of their investments, and the job market could become increasingly competitive. But let's not despair. Recessions can also be times of opportunity and growth. Individuals can use this time to upskill, diversify income streams, and reconsider spending habits. Small businesses can innovate, find new markets, and streamline operations. Investors, on the other hand, can seize the opportunity to buy stocks at lower prices. As for the job market, while some industries may struggle, others could flourish, providing new career paths for those willing to adapt. During these uncertain times, informed decisions become crucial. So, while a recession can be challenging, it's not the end of the world. With the right strategies, we can navigate through it. History often repeats itself, but it also teaches us valuable lessons. As we navigate the murky waters of this economic downturn, let's turn to the pages of history for guidance. Past recessions, like the financial crisis of 2008, have shown us that economies, though battered, have the capacity to recover, adapt, and evolve. They've proven their resilience time and again, bouncing back through a combination of effective policy interventions, shifts in business strategies, and the indomitable spirit of the workforce. In the aftermath of these downturns, new industries have emerged, old ones have been transformed, and innovative economic models have been born. From the ashes of the economic slowdown, the phoenix of progress arises. These historical recessionary cycles should not just be viewed as periods of economic distress, but as opportunities for growth and innovation. They should serve as a beacon of hope, reminding us that downturns are temporary and that every economic winter is followed by a spring. Remember, it's always darkest before the dawn, and every recession eventually leads to an economic sunrise.